Welcome to the deep dive. We sift through the noise, the reports, the data to bring you, well, the core insights you need. Today, we're jumping into a real heavyweight bout, the big tech battle royale. We're doing a comparative stock analysis. Apple, Alphabet, Meta, and Netflix. Our mission to look at the source documents, compare their strategies, their big spending, especially on AI, and see where the reports suggest, the potential value might be.
Right. And look, before we even start, we absolutely have to put this out there.
Mm-hmm.
This is for information, for education. It's us summarizing research. We are not financial advisors. Seriously, none of this is investment advice. Please do your own homework, your own deep research before making any decisions with your capital.
Couldn't agree more. So critical. Okay, let's just set the scene with scale. Apple. Still the giant, right?
Yeah.
Market cap just ticked over, what, $4 trillion?
So yeah, around $4.01 trillion based on the latest close. Huge number.
Then Alphabet, Google's parent, comfortably number two, $3.4 trillion.
Solidly there.
Then a bit of a drop to Meta Platforms, $1.63 trillion. And Netflix, the smallest of this group we're looking at today, is just shy of $500 billion, about $474 billion.
Still massive companies, obviously. But those numbers really frame the context for this intense AI arms race that's really shaping everything right now.
Exactly. Let's get into that first, the AI race and how each company is building its competitive moat.
Yeah, AI is definitely the key strategic battleground, but interestingly, they're all playing it quite differently. Let's start with Alphabet, Google. They're really going for what the reports call the full stack approach. So world-class models like Gemini, sure, but also designing their own silicon, the TPUs, 7th gen now, and integrating NVIDIA's best GPUs.
So they're not just building the AI, they're building the whole infrastructure, like selling the picks and shovels in the gold rush.
That's a great way to put it, exactly. And you see that investment paying off, like right now in Google Cloud. Revenue growth there was 34%. And the lock-in is incredible. They mentioned a $155 billion backlog in future business. Plus, they apparently won deals with 9 out of the top 10 AI labs globally. They're becoming the go-to infrastructure provider.
Okay. And financially, how does that stack up?
Well, the balance sheet looks very strong. Debt to equity is super low, 0.09. The PE ratio trailing 12 months is around 27.35, which, isn't cheap. But given that cloud AI dominance analysts seem to think it's, well, reasonable for future earnings potential.
Okay, so Google's building the infrastructure. What about Meta? They're not exactly selling cloud services in the same way.
No, Meta's moat is different. It's sheer scale, human scale. Think about it. 3.5 billion people use at least one of their apps, Facebook, Instagram, WhatsApp, every day. Their stated goal is becoming a frontier AI lab, but they're monetizing AI immediately by turbocharging their main business, advertising.
So using AI to make the ads better, more targeted.
Precisely. And the results are already there. The reports say their AI-powered ad tools are running at an annual rate over $60 billion. They're improving targeting, recommendations, driving engagement, which means, ultimately, more money from ads. So, unlike maybe some of Google's big CapEx bets, Meta's AI spend is hitting the bottom line, like right now. Interestingly, their PE is almost identical to Alphabet's, 27.88.
Okay, then we pivot completely to Apple. They're not building giant public AI models or selling AI cloud infrastructure, are they?
No, not at all. Apple's moat is that famous walled garden, the ecosystem, and premium stability. They lean heavily on the stickiness. Did you see that stat? 98% customer satisfaction for iPhone users in the U.S. That's just 98%. Yeah, that's loyalty. And that loyalty feeds directly into the services segment. App Store, iCloud, Apple Music, all of that. Hit $28.8 billion in Q4 revenue, growing 15%. Their AI play is vertical integration. They use their own Apple silicon. The new M5 chip is mentioned to power on-device features. They call it Apple Intelligence. So it's about integrating AI into the user experience, making the device smarter, and charging a premium for it.
And that premium shows up in the valuation, right? Their PE looked higher.
Definitely. It's quite a bit higher than Google or Meta, sitting at 36.08. You're paying for that stability, that ecosystem control, that brand premium.
Okay, last one in this group. Netflix, the content king. How does AI fit in there?
Well, they're not really in the chip race or the foundational model race like the others, but they absolutely use AI constantly. Think recommendation engines, optimizing content acquisition, making production more efficient. Their mode is really about having stuff people want to watch, high view share, global franchises.
And the big story for them recently, according to the reports, seems to be monetization, especially ads.
Absolutely.
Yeah.
That's the key narrative right now. They're leveraging their huge subscriber base with this rapidly scaling ad business. Analysts are projecting it'll more than double its revenue this year. And because they generate so much free cash flow, the guidance for 2025 is around $9 billion. They can fund all that expensive content, mostly internally. They also announced a 10-for-1 stock split, which tends to excite the market. But yeah, this focus on content execution and ad growth means it trades at the highest premium of the four. PE is way up there at 45.65.
Okay, so we've got these distinct moats, these different AI strategies, but building and maintaining them costs serious money, doesn't it? Especially for Google and Meta, who are building out this massive infrastructure.
Oh, absolutely. This is where the trade-off really bites. Let's talk CapEx versus valuation. Think of Google and Meta like they're building, I don't know, the digital equivalent of the entire national highway system right now. Apple, meanwhile, is maybe upgrading the leather seats on its private jet fleet. Both cost money, but it's a different kind of spend and scale.
Give us the numbers. How much are we talking?
Okay, so Alphabet, Google, updated their CapEx guidance for 2025, $91 billion to $93 billion. And they explicitly said expect a significant increase again in 2026. Meta's right there with them. They bumped their 2025 CapEx guidance to $72 billion and also projected spending to grow at a significantly faster percentage rate in 2026.
93 billion,
Yeah.
72 billion. Those are just astronomical numbers. How does spending that much, say on data centers for Google, actually hurt their profit and loss statement right now?
Great question. It's depreciation. When they buy all those servers and build those data centers, they have to account for the fact that those assets lose value over time. That depreciation charge hits the income statement immediately, quarter after quarter, even if the massive AI revenue they hope those servers will generate is still, a year or two down the road. The report mentioned Alphabet's depreciation expenses were up 41% in Q3. That directly squeezes profit margins now. It's a huge competitive barrier they're building, yes, but it means investors need to stomach lower near-term earnings for that potential future payoff.
Right, which makes the valuation piece absolutely crucial. Is the market already pricing in that future payoff, or is there maybe some value being overlooked? Let's talk fair value estimates, or FVE. Can you quickly explain what that is?
Sure. So analysts create these FEEs through detailed financial modeling. They project future cash flows, earnings, discount them back to today's value, essentially trying to figure out what the stock should be worth based on those future fundamentals.
Okay, so how do these four stack up against their FVEs according to the sources?
Well, this is where it gets really interesting. The market seems to have really high hopes for the current leaders. Apple, for instance, is trading above its fair value estimate. The closing price was $207.37, while the FVE cited was $228.20. Alphabet, Google, is in the same boat, trading at $281.82 versus an FVE of $257.67, so also above.
Wait, hang on. If Google's spending $93 billion on CapEx, wouldn't that huge expense drag the fair value estimate down? Does this mean analysts are maybe too optimistic about how quickly that spending will pay off?
That's the million-dollar question, isn't it? Or maybe the $93 billion question. It highlights the tension. Analysts are clearly betting that the AI revenue surge will eventually drastically outpace that depreciation drag. But for now, it seems the market is rewarding that massive infrastructure spend with a premium price, despite the near-term earnings pressure. It's pricing in the future dominance. Now, contrast that with Meta. Here, the story flips. Meta is trading significantly below its fair value estimate. Closing price $648.35, but the FDE was $775.52.
Oh, okay. So Meta, even with huge AI ambitions and proven ad monetization, seems to offer potentially more upside relative to these analyst targets. Why would the market be discounting them more?
The discount seems largely tied to perceived risks. Persistent measurable risks. Yes, they have massive scale and AI success in ads, but the reports highlight major regulatory headwinds. You've got the EU scrutiny on personalized ads, potential U.S. lawsuits regarding youth safety expected in 2026. These could materially impact their business. And, of course, there are still the ongoing significant operating losses from Reality Labs, the metaverse division. So the market seems to be pricing in that regulatory uncertainty and the metaverse spending, maybe more heavily than it's rewarding the core AI success.
Good point. And we should probably mention the key risks flagged for the others too, right?
Definitely. For Apple, the documents mentioned potential supply constraints, limiting sales, rising operating expenses, particularly in R&D, and also tariff costs. They estimated a $1.4 billion hit just in Q4 from tariffs.
And for Google, beyond the CapEx pressure.
Yeah, besides the P&L pressure, they flagged a tight supply-demand environment for cloud AI infrastructure continuing well into 2026, meaning they might actually struggle to meet all the demand immediately, which could cap growth temporarily. And you can't ignore the other bets segment, Waymo, Verily, etc. Still losing money consistently. About $1.4 billion operating loss in Q3 alone. It's a steady drag.
Okay, so putting it all together, these different moats, the huge CapEx differences, the varying positions relative to fair value. If you had to sort of summarize the trade-offs here, based purely on this data, how might someone think about these choices?
Well, it really boils down to your risk tolerance and investment horizon, doesn't it? Apple seems to offer the most stability, that premium growth backed by the incredibly loyal ecosystem. But with a PE of 36 and trading above its FEE, you're paying a high price for that stability. The execution needs to be nearly flawless to justify it, arguably.
And the big infrastructure builders, Google and Meta.
They represent bets on explosive, transformative growth from AI and the cloud. Alphabet offers perhaps a slightly stronger financial footing, with that low debt, and clear dominance in the AI infrastructure space already. Meta, however, based on these numbers, offers that significantly better valuation relative to its FEE compared to both Apple and Google. Investing there means accepting the massive CapEx spend and navigating those serious regulatory threats we mentioned. It requires more tolerance for volatility, perhaps.
And finally, Netflix, the highest PE.
Netflix is all about execution on content and ads. That PE of 45.65 is demanding. It's justified if you believe in their high free cash flow generation and their ability to keep scaling that ad business rapidly while churning out global hits. It's a high-growth, high-multiple story.
Okay, so different profiles, different risks, different potential rewards.
Exactly. And maybe the provocative thought to leave everyone with, considering the absolutely massive universal spending on AI infrastructure by Apple, Google, and Meta, what happens if the returns on these tens, even hundreds of billions in CapEx? What if they don't materialize quite as quickly or as massively as the current growth projections seem to demand? That potential gap between the immense spending now and the realization of revenue later feels like the central tension, the key risk across big tech for the next few years.
That is the core question, isn't it? Is the market correctly pricing that future potential, or is it getting ahead of itself? A lot to think about. Well, that's our time for this deep dive. If you found this breakdown useful, please do take a second to subscribe to the channel, hit that notification bell. It really helps support the research we do for these sessions.
And just one final tip for your own research, building on what we discussed. Maybe go look at the actual projected revenue growth rates for 2026 that were cited in the documents.
Yes.
You've got Apple projected at 7.32%, Alphabet at 13.13%, Meta actually leading this group at 17.8%, and Netflix at 13.07%. Compare those growth rates to the valuations we talked about. Does the expected pace of expansion justify the current price for each? Just more food for thought. And remember the disclaimer, do your own research.
Absolutely. Thanks for tuning in, everyone. We'll catch you on the next deep dive.